Good morning, everyone, and thank you, Ketan sir, for this opportunity, and thank you for the brief introduction. It's a pleasure always to speak at WIRC. Many were asking me why you're speaking on AS and not on Ind AS. But frankly, preparing for this lecture, rereading the standard once again, so many thoughts came up to mind. And I thought, as Ketan sir correctly said, for the SMPs, they need support on these standards. All the four standards on which I'm going to speak, that is AS 10, AS 16, 26 and 28, any error made in accounting will have very serious impact on the entity's financial statement, and it will put pressure on the auditor how he is going to certify true and fair. So these standards become important in that context. Auditing and reviewing expenditure incurred for property, plant and equipment in my days when we were doing our articleship was done by very senior and experienced chartered accountants and always reviewed by the partner. Today it is delegated down the line. You'll have seniors. You may also have a third year article who will be doing audit of this. So unless and until they do not understand the nuances of what goes into accounting, it may become very difficult for the firm to say that we have done a proper audit and the entity's financial statements are error free and therefore they can be certified. So in this background, I'm just sharing some thoughts which came up to my mind when I was preparing for this. Considering the paucity of time and there is 4 standard to cover, I'll be only covering very, very important and relevant part, sharing in middle what the experience which I have gathered for my experience of past 30 years. So by the time they are getting started, I'll start off because there's hardly any time left. Yeah. So if you see any typical company's balance sheet, around 65 to 70% of the investment will be in property, plant and equipment. That's the whole purpose why the business is started and why they invest. Now why property, plant, expenditure on property, plant and equipment needs to be on the balance sheet and not in the profit and loss account? Because these expenditures or this investment is made to earn revenue. So that's the first thought process which should come to mind. Okay, why a particular expenditure has been done. And before the expenditure you certify is true or correct, one has to understand the nature of business. What is the type of asset the company is invested, whether it is really going to earn revenue for which the company has been set up. Okay. Yes, there will be investment in assets which are administrative in nature. Those are required. But otherwise, one of the primary things to be ensured is that the investment is made in an asset which will earn revenue for the entity, and the revenue activity is within the object clause of the memorandum. So one has to understand the business properly. One has to understand why this particular expenditure is done, and then the accounting aspect comes in. The objective, just to run very quickly, the objective is to prescribe treatment of property, plant and equipment so that the user of the financial statement can discern information about investment made by the enterprise in property, plant and equipment and the changes in such investment. So the whole purpose is to earn revenue. That's the idea of having this investment made. What we'll be primarily covering will be recognition of an asset, determination of carrying amount, depreciation, testing for impairment to recognize losses if any, retirement and derecognition, subsequent measurement models and disclosure. There's a host of definition which is given in the standard, but we won't go into all those. Just talking about exemption from this standard. The standard does not apply to biological assets related to agriculture activity other than bearer plant. And there are other ones also, but I thought this was a little important because bearer plants will be accounted, but the activity or the output of that will not be covered by this standard. Another important definition which I thought is relevant is the carrying amount. What should be the carrying amount of property, plant and equipment? The carrying amount is the amount at which the asset is recognized after deducting accumulated depreciation and accumulated impairment losses. Generally, impairment losses are not taken care of. We just conveniently forget it. But today, just very recently, those of you who have been following what's coming in the newspaper, NFRA has made a very significant observation with respect to one audit firm that they have not done impairment testing adequately. And therefore, in NFRA's opinion, the accounts were not true and fair. So, irrespective of the size of your entity, you need to test for impairment. We'll be dealing with this once we come to that particular standard. Another important is value in use. What is the definition of value? Value in use is the current value of an asset rather than its potential or market value. It is the present value of cash flows that an asset is expected to generate. As I mentioned earlier, the asset is purchased to earn revenue, and revenues are determined from cash flows. So this becomes very, very important. What is the value in use? We'll be dealing this much more when we do the standard on impairment. Another important which I thought was gross carrying amount of an asset is the cost or other amounts substituted for costs in the books of account without making any deduction for accumulated depreciation and accumulated impairment losses. So when you are presenting your fixed asset schedule, generally we have a column in the schedule where we show accumulated depreciation. I also suggest, we'll be also showing what other companies are doing, that you need to have a column for accumulated impairment provisions made. So impairment provision is a necessity, though many entities will tell you, no, we are making profit, so impairment testing is not required. Please do not do so, or if you're convinced, ensure you have proper documentation. So tomorrow, if you're hauled up by any regulator, you at least have that. Yeah. Key features of property, plant and equipment. So we are going to talk about the tangible aspect of the property plant because there's another standard which we'll be covering will be on AS 26 on intangible, but the principles by and large remain same, so I won't repeat whatever is here. The key features, they are tangible, they are physical in form. The PP consists of tangible assets held for use or administrative purpose. So if you buy a copier, photocopy machine, or if you buy a printer, or if you buy a refrigerator which is used in your pantry, those all will become part of property, plant and equipment, though they may not be directly generating revenue, but they are helping the organization to be more efficient. Usage, not for sale. So if you have a property, plant and equipment which you are purchasing for selling, then they don't become PPE, they become inventory. So so Tata Motors, they are selling cars. If I buy a car, it will be a fixed asset for me, but for Tata Motors, it is an inventory. So one has to understand what is the purpose for which it has been procured. So you're procuring not for sale, but you're procuring for using it to generate revenue. These assets are long term, they are non-current. They are non-current assets and expected to be used for a long period of time, not early conversion to cash. So if you're buying an asset for a very short duration, then as an auditor, one has to inspect why the asset was purchased. There should be a reasoning, and generally this is something which we always see, but many times this is something which has been skipped also. Administrative purpose, the term administrative purpose has been used in a wider sense to include all business purposes other than production or supply or services or for rental. It includes asset used for selling and administration, accounting, financing and payroll management. So if you have a payroll software which you have purchased, or you have purchased a special hardware which you are going to use for processing your payroll, they'll all form part of the fixed asset. Recognition criteria. Now this is something which I thought is very, very important, but we don't give due attention to it. One of the important criteria for recognizing property, plant and equipment is future economic benefit. So as I mentioned in the introduction itself, that you are purchasing to earn revenue. You are not purchasing for the sake of purchasing. So what is the type of future economic benefit that the company is going to get from this expenditure needs to be evaluated for it to qualify to be on the balance sheet as a property, plant and equipment. It should be measured reliably. So if there's an element of doubt, you do not know how to measure it, then one needs to really question whether it still qualifies to be a property, plant and equipment. So it should be measurable very reliably, and materiality is also an important. Insignificant items generally may get aggregated. Enterprise may expense out immaterial items. So many large companies which we ordered, so ceiling fans, table fans, all these are expensed out. Though in small entities they may become property, plant and equipment, they will be capitalized as fixtures. But many companies have made an internal policy that if you purchase items which are below 10 or 15,000, they may expense out. They put that note also in the tax audit, because in tax audit we have to comment whether any expenditure of capital nature is debited to P&L. So generally they put that note also so that they don't declare it. So these are some things which are very, very important. Property, plant and equipment classification as inventory, spare parts, standby equipment, services equipment are classified as property, plant and equipment if they meet the definition. Otherwise they are classified as inventory. Okay, so one actually has to see for what purposes these spare parts are. Generally you import a machinery and there will be a lot of standby spares which may come. You can capitalize those as part of the machinery cost. That's what it is. Yeah, because every time you need a replacement, you can't spend time to get those parts. So standby parts are always imported along with the original one. Elements of property, plant and equipment cost, purchase price. Now this becomes very simple. You can see there's a purchase order, there'll be an invoice which will get recorded, the plant and equipment will be debited. But what's important is how you're going to deal with taxes. So taxes on which you are not going to get an input tax credit, that you are not going to get a credit out of it, then that should be capitalized as part of the purchase cost. So non-refundable taxes should become part of the purchase cost. This is very important in SMPs where many times this difficulty arises that we feel we'll be able to get an input tax credit, but it doesn't happen. So it's better to capitalize it as part of the parent cost of that particular plant and equipment. Discounts and rebates have to be deducted. Direct costs for bringing assets to their location. Many times these are not captured because they are incurred, the payment is not made to the supplier of the equipment, the payment may be made to another vendor. For example, you may buy a property, plant and equipment and you may hire a carrier to cart it from the seller's premises to your factory. That cost also needs to be captured and capitalized. But what should be capitalized, what should not be capitalized is an important decision which needs to be evaluated. Examples of directly attributable cost are employee benefit arising from construction or acquisition, site preparation, initial delivery and handling charges, installation, testing. Now testing also is an important aspect. When you buy a new machine, it takes time to settle down. Machinery just can't start once you fix the wire in the socket and press, the machine doesn't start. It requires a setting time. So one has to really look at it holistically. What is the type of time frame is required to set up this machine? So initially it may be in CWIP. It'll be parked there till it gets actually ready for its intended use. So in that point in time, one needs to ensure that the company has the process to identify and to capture the capitalization. But many times, from my experience, what we have seen, that inefficient costs are also getting capitalized. So be careful that inefficiency under no circumstances should be capitalized, because they don't add to the economic value. The value of the machine should be realistic, and only what expenditure is required to get it started only should be capitalized. Exclusions from property, plant and equipment cost, pre-use cost, initial losses, relocation expenses. Yes, generally you may relocate a plant from one location to another. Those should never be capitalized. They are all revenue and expenditure. They are never adding to the value. They don't increase the efficiency of the machine. They are only administrative, that you are just shifting it from one plant to another. Cost of opening new facilities, such as inauguration cost, very obvious, should never be capitalized. Cost of introducing a new product or a service, including cost of advertisement and promotion. This will deal a little more in detail when we do intangibles. Cost of conducting business in new location with new class of customers, including staff training. So staff training again is a gray area. Many times when you are importing a machinery, the seller may say, for example, the seller is located in Europe. He may say, please send your technical team here. We need to train them how to use this machinery. Our technical team won't come to India. We will train your people. So that cost is important, because without that cost being incurred, or without that training, the machinery cannot be started, or it cannot be used for its intended purpose. So that cost can be capitalized, but otherwise routine training which you happen in the shop floor, those should never be capitalized. Administration and other general overheads, please apply skepticism to see whether they really warrant, and your documentation should be very clear why you permitted this capitalization of administration cost and how did it serve the purpose. Cost of self-constructed assets. This is very important. Many companies have this. They in-house. They may construct assets like molds, dies, jigs, fixtures. Some of the companies, they spend a lot of money in doing that, because they feel they have in-house expertise and they can reduce the cost. But that's also one place where a lot of inefficiencies, a lot of administration expenses gets capitalized, which otherwise should not be. Okay, so those will have direct impact on the P&L, because otherwise something which should have been on the P&L will be going to the balance sheet wrongly. Same principles as you have acquired an asset. So one has to apply a very simple test when you're doing that. Sorry, I'm talking a little from the audit point of view, because accounting they'll do, but I think that's very important as auditors for us also to know what the client will do. They may debit the right account, but what should be debited and what extent it is debited is that somewhere we should be very careful with. So one of the tests is, had I purchased this asset, what would have been the cost, and what is the cost coming out of self-construction? In the normal circumstances, self-construction cost should have been lower, because I will not be capitalizing margins. As I mentioned, eliminate profit. So there will be removal of margin, but if I buy from a third party, he will be adding his margin and selling. So that's one saving which will happen. So that's something which one should use as a thumb rule, that this asset is constructed. Had I bought it from outside, what would have been the cost? Exclude wastage. Do not include cost of abnormal wastage, material, labor, or inefficiency. Now this again, many companies, from my experience, they want to capitalize a lot of expenditure in terms of material, labor, and inefficiency. So it becomes a big debate, and that's where we need to apply professional judgment. We need to be using skepticism, and we need to be very, very careful to ensure that what is getting justified. Because as far as the company is concerned, they don't have to answer, but the auditors need to answer a peer reviewer, you need to answer a QRB reviewer, and now you need to answer to NFRA and also to other regulators who may haul you up why this particular expenditure got capitalized. Other consideration, AS 16, that is borrowing cost, establishes criteria for recognizing interest as a component of carrying amount of PP unless non-capitalization of interest on borrowing costs is justified. We'll also deal with this. Bearer plants are accounted in the similar way to self-construction asset before they are ready for use. If payments are under deferred facility, then the difference between the cash price equivalent and total payment recognized in the interest. So be careful if you are going in for those facilities, then do not capitalize interest, which the company may be wanting that to be capitalized because they thought that they can get away. It will impact their profitability. Small things, but one needs to be careful because this particular aspect, it is delegated down the line, maybe to third year article, newly qualified. So the supervision on these parts become very, very critical. PP acquired in exchange. This is a normal thing to happen now. It's a very regular feature. How many companies get property, plant and equipment in exchange for the old one, new one. How to account. The cost of PP acquired in exchange for non-monetary asset is measured at fair value. Now this is something which many miss. Fair value accounting is important, even for a non-listed, non-Ind AS company. So fair value is here to stay now. Unless the exchange lacks commercial substance or fair value is not reliably measurable. The acquired item is measured as above, even if the enterprise cannot immediately de-recognize the asset given up. So before you capitalize an asset which you are acquiring on exchange, that means you're giving up one asset and getting another one, you have to ensure that the company has identified the old asset, which needs to be removed out. Yeah, many times they may not do it, but you have to insist or at least take it up at your partner level for discussion. If you are doing listed company, it is easy because we have the audit committee who will help us out. But otherwise, we need to take up at least with the promoter of the company that this is very important. Well, otherwise there would fear of over-capitalization. So assets should never be over-capitalized. It should be capitalized at the fair value. So if the old cost is not removed out and the new cost gets capitalized, there's a chances of it getting over-accounted. Fair value is reliably measurable if variability is not significant and probability can be accessed. Yeah. So carrying amount of the asset given up is very important to understand. Otherwise, you may have to bring it in your MRL that yes, the company is not able to identify, and as for the company, the cost which could not be removed out is insignificant and will not materially impact the profitability. So something or to that extent you may take it. But as I just want to mention, as it's been said in many forums, that management representation is not an audit evidence. MRLs are not audit evidence. They are only comfort. So many clients will tell you, we'll give you an MRL. We can't have this invoice. Aap MRL mein dal do na. Put this in the MRL. MRL is not a substitute for audit evidence. So please ensure, do not buy that argument. Ensure that you have a proper audit documentation. Where there are several items of PP are purchased for consolidated price, that's where the issue arises. You need to use a little bit of arithmetic, how to allocate what each asset should be valued at. The consideration is apportioned to various items basis their respective fair value at the date of acquisition. Else, one has to do valuation. But in small companies, they may not want to do valuation. They may want to use an alternate method because valuations are expensive. Subsequent cost and replacement of part. Yes, subsequent cost, as I mentioned there, new part capitalized as carrying amount, used as replacement of old parts. Now this is permitted. In the old standard it was not. After the amendment, now if you see AS 10 is almost very near to Ind AS, whatever under the Ind AS we have for property, plant and equipment, this AS 10 is almost there, which is permitting capitalization of the new parts. Removal of the old part has to be done and written off to P&L. Servicing charges to be charged off to P&L. So these are the subsequent costs which get incurred. So one again needs to apply a lot of professional judgment. Are they adding to fresh value? If they are not adding to fresh value, then they need not be capitalized. They need to be revenued. Yeah? Cost of day-to-day servicing are recognized in the statement of profit and loss account. Such costs are primary labor and consumable. If there is replacement of part, the cost is recognized in the carrying amount, that is capitalized when incurred if the criteria is met. So first ensure the criteria is met and you document what is the basis that you applied to ensure a replacement cost meets the criteria. The carrying amount of replaced part has to be recognized. Again, please ensure it is done simultaneously. It should not be, somebody will say, okay, allow us to capitalize at the year end, we'll pass these entries. They don't get passed. So be careful because that's the place where all the risk takes place. Regular major inspection. Now this is also a new amendment which has come in. In the past, any repair was not allowed, but now with the new amendment, they said yes. For example, if a ship is sent for dry docking. Now in dry docking, the entire ship is overhauled. A lot of expenditure is spent. Most of the parts are replaced. Most of the parts are retuned. Yeah. So these costs can be capitalized because they are adding fresh life to the vessel which has gone for the dry docking. The cost is recognized as a replacement cost if the criteria is met. And again, the old cost needs to be removed out. Yeah. Challenges, how to calculate and identify the remaining costs. This I've been re-emphasizing. So before you permit capitalization, ensure that the old cost is identified for removal. If it is not practical for the enterprise to determine the carrying amount of the replacement part inspection, it may use the cost of replacement. So what costs replaced it, use that for removal so that, ultimately there is no overcapitalization, but you are removing something on an estimation and management estimation is permitted. Mention the basis you used and why you permitted that judgment. Many times, if the company is a listed company, they may have a valuation done, so it becomes very easy. You have a third-party report, but in case of small clients, it may not be. So you need to just put up in your paper what skepticism you applied and what test you applied for removing that. Component accounting, this is also an important feature in the amended standard. At initial recognition, the enterprise allocates amount in respect of an item of property, plant and equipment to its significant part. For example, if a company is purchasing an aircraft, the cost of the body and the cost of the engine are two different costs. One is significant, both have different useful life, they both have a realizable value. It's all very different. So the standard permits you to break the cost into two parts. You account for that separately in your FAR register. You show the cost of the machine, or your cost of the engine and cost of the body separately. But when you show it in the fixed asset schedule, it will be one asset itself. In Schedule 3 to the Companies Act 2013 requires that useful life for significant components of tangible assets should be determined separately. This requirement is commonly known as component act. But it is very challenging. One has to understand why a particular, so what you have to mention to the company is that initially when they are going to buy, they have to tell the seller to give a breakup of what in the seller's opinion is the cost towards the engine and cost towards the body. So you have the bifurcation right in the invoice, and accordingly you can capitalize. Measurement after recognition, I think we've covered this briefly, how to show it. So when you use the cost model, you'll be showing it at original cost, less accumulated depreciation, less accumulated impairment. So this is again emphasize, impairment loss needs to be identified year after year. Yeah. And it needs to be documented on your file. Changes in the asset value are not recognized in income until the asset is sold. So when you're following the cost model. You can also have a revaluation model, but as the standard says, revaluation has to be done frequently. It should not be done once. In the old regime, we used to do revaluation once and then just leave it that. But the new standard says no, because you have opted for revaluation means you are opted for fair valuing your asset from time to time. So that needs to be seen. Yeah. So fair valuation is determined from market-based evidence by professionally qualified or registered valuers or estimated using income. Yeah. So again, the revaluation model which the companies use, spend time to understand what is the basis, spend time with the technical team who have initiated the process, and ensure that proper costs are brought on the book, on the balance sheet. Frequency of revaluation depends upon changes in the fair value of property, plant and equipment being revalued. Further revaluation is done if the fair value of the revalued asset differs materially. That means fair valuation or re-inspecting the fair value has to be done frequently, balance sheet to balance sheet, and updated. If the carrying amount is increased as a result of revaluation, what type of accounting to be done? Credit directly to the owner's interest under the heading of revaluation surplus. Recognize in the statement of profit and loss to the extent it reverses a revaluation decrease of the same asset previously recognized in the statement of profit and loss account. So if in the earlier accounting period you have debited or credited the P&L, when you do the revaluation again, ensure that you just undo what was done. So keep consistency. If you have charged to P&L, credit to P&L. If you have debited or credited revaluation surplus, do likewise. Don't change it, though the client may, give its own justification, but that's not acceptable. If the asset's carrying value decreases as a result of revaluation, the decrease should be recognized in the statement of profit and loss. Yeah. Depreciation, I think we'll skip. Everybody is quite aware, but only one thing which I just want to emphasize, that at the balance sheet date, the residual value, useful life of an asset, and the method of depreciation should be revisited. You may revisit it, but don't make the mistake of not documenting. So many regulators have found that the partner said we did it, but the file doesn't speak about it. So please document, because the file has to speak for itself. You won't get a chance to defend. Everything has to be in black and white. So so whatever you're doing, you're revisiting, ensure you document it. In case of component accounting also, many companies have erred on how the component accounting is done. The FAR does not mark the difference of the useful life. So if you have the fixed asset register and you're following a component accounting, so there are two parts which got capitalized. Ensure the fixed asset register very, very clearly mentions what is the useful life of each part, because that is the only evidence that will stand you in good stead. Method of depreciation we'll skip. Component method we have also done. Grouping of components, yes, many times significant parts of property may have useful life and depreciation method that are same. They can be clubbed. Again, apply professional judgment to see whether they really warrant clubbing together, because apples cannot be clubbed with oranges. So ensure that we do that. In fact, those of you who are doing tax audit, we apply this when we are calculating depreciation and block of assets. Assets which are having the same depreciation all clubbed together, and depreciation is then calculated. So this is something which I thought, examples of exceptions to the above. AS2 depreciation amount of manufacturing plant and equipment is included in the cost of conversion. So depreciation should be charged to P&L, but there's an exception if the depreciation is used for inventory valuation. So depreciation which is incurred for manufacturing assets are used when you are calculating your absorption cost for loading on inventory. So that is permitted. So to that extent, it will not be debited to P&L, but it will be recovered to the value of inventory. In AS26, depreciation of property, plant and equipment used for development activity are capitalized. So when I'm going to we'll deal with that when we do AS20s. This is some of the misconception and myths which we come across. Many times these are the explanatory we get from the head of the accounts and also from the promoters. Depreciation should not be recognized if fair value of the asset exceeds its carrying value. No, it should not. Depreciation should be accounted every year. It is required by the regulator. Repair and maintenance negate the need to depreciate the asset. So they will say, okay, we have incurred such a large expenditure on getting the asset up and working. So depreciation may not be. Again, do not get carried away. Charging depreciation is a management choice. Okay, this is some of the explanation which we have got, but it's not correct. Depreciation ceases when the asset is retired from active use or is idle. Again, not. Depreciation ceases only when the asset is fully depreciated. So even if the asset is idle, you need to depreciate it. Yeah. Depreciation cannot be zero for any financial year. It can if you are using the method, usage method, that is depending on the production. So if there is no production in that particular year, that asset has not been used, so depreciation can be zero. Land and building cannot be accounted separately if acquired together. Again, a misconception. They have to be accounted separately. If you do not know the cost, you can do a valuation, okay, or you can ask the seller to give the cost which he has, or you do an independent valuation. But they need to be separated. Building needs to be depreciated, land may not be. Okay. If the value of the land on which the building is erected stands increased, it impacts the depreciable value of the building. No, it's not true. Okay, what happens to the land is independent. Building is very independent, so it won't get affected. Under no circumstances the cost of land can be depreciated. It can be if the land has a finite value. So you may have a land whose useful life may be very small because it is in a very bad area, and because of deforestation or environment, the land has a finite value. It can happen, depreciated over that initial finite value, a finite period over which you feel the land will get depreciated. So these are some things very practically coming out from yes. Yes, that is correct. So you have to always see that what is the economic life and what is the useful life, so it can be. The most important part, the new addition or amendment which is there, next one, is changes in existing decommissioning, restoration and other liabilities. This was not there, but this is brought in to bring it in line with IFRS. Now, many a times the company sets up a large plant on a leased asset. Okay, the land is on lease and you are setting up a plant, say for 30 years. After 30 years, you have to give the land back. That means you need to incur a dismantling cost. One is dismantling cost, second is restoration cost. You have to give the asset which you have acquired, the leased land, back in its original form. So you will be incurring an expenditure. So the standard very correctly says you need to make an estimation. What will be the cost 30 years hence? Okay, apply discounting value find out the present value of what is the cost and capitalize that. So that needs to be capitalized. Such costs have to be estimated and accounted. The changes in existing decommissioning, restoration and other values can arise due to change in the estimated cost, increase or decrease. Every balance sheet day you will re-estimate what is the cost that I thought would be there after 30 years. After 25 years you revisit, okay, you feel the cost is enhanced, increase that provision, again apply present value. So you need to do this exercise again and again. And it's very, very logical, because after 30 years, if you have to dismantle, you'll have to introduce capital. And that capital will not be for earning revenue. That capital will be for restoring this asset. The same thing happens with depreciation. Why depreciation is also charged? Because you're keeping a small amount away, so that when the asset goes, you have the amount which is stored, kept aside to replace the asset which has been fully depreciated. So this is very, very important. So when you are doing your property, plant and equipment, at least the seniors, managers, partners will definitely do it. I request you to please take this up in your discussion point. Those of you who are doing listed companies, take it up with the audit committee. Let it be in your PP, your presentation to the audit committee, that the client says or the representation says there is no restoration or decommissioning costs to be incurred. So whether they are right or wrong, how will you know? You must know the business. So if the company is in oil rigging and they have got a rig at Bombay High, you read the agreement says this rig will have to be dismantled after 60 years and the seabed has to be restored. Now you can't say there is no cost. You have erred in understanding the business. You have erred in interpreting the agreement. So the fault will be of the audit team who have not understood. So those of you who are doing that, at least take it up with the partner's discussion point. Let him also understand what is the type of observation you have made. Yeah? And lastly, put it in the MRL in case of small entities that you feel there is no restoration cost. Now, those of you whose clients have had office in some of this large business park, two of my clients had offices in large business park in Andheri, where the agreement says that when you are shifting, take all the equipments, all the expenditure that you have done, or do not remove any asset out. So many companies have just moved out, leaving the refrigerators, leaving the ACs, leaving the tables, because they say either you take everything or take nothing. So that's a new thing which is coming up in this business parks. So these costs have to be factored, they have to be capitalized, and you have to ensure that they get depreciated. Wherever present value has to be applied. So we have an example. You can just put pull out Excel sheet. Yeah. So this is the example, a very simple example given in the standard only. A company sets up a power plant on leased land. As per the lease agreement, the company must dismantle the plant and restore the land at the end of 10 years. Estimated cost of decommissioning at that time is 10 crores, discount rate is 8%. So you apply the discount rate and find out what happens after 10 years. So the present value comes to 4.63, capitalize 4.63 as part of PPE. Every year you go further. Take it up. So that's the journal entry you'll pass. You'll capitalize 4.63 and you'll credit provision for this commissioning liability. You'll unwind the interest of 10 years. So every year you will have the interest cost which will be there. You'll unwind that. Finance costs will be debited. Provision for decommissioning will be credited. Yeah. So this is the spreadsheet which is there, which is very clear. Yeah. So 5.36 will be the interest charge, which will happen after 10 years, cumulative interest. Every year you will have interest charge which will be there. Cumulatively it will be 5.36, which will be again credited to provision for decommissioning. So you will be capitalized 4.63, 5.36 will be charged to P&L over a period of 10 years, and at the end of 10 years, go further, you will be paying 10 crores, which will be paid off. So you'll have debit provision for decommissioning and credit bank. That is what you'll be paying. So do not forget to do this. Looks very simple, but we generally forget this. So 4.63 need to be capitalized. 4.63 will also be depreciated over 10 years. So that cost also will be recovered and you'll be correct. So this is a very important accounting aspect which will be there in this time. Yeah. Go to that. So I've just summarized. Let's go to that summary. Yeah. So this is just a summary of what happens, summary of impact on each component of PP, carrying value, liability and P&L. So if there is an increase in the estimate cost, liability will increase, PP debit will be increased. Expense if fully depreciated. So if the asset is not there in existence, expense that increase out. If there is a decrease, simultaneously. If there is a decrease in the discount rate, again it will impact, the liability will increase, PP will increase, expenses out if fully depreciated. So these adjustments should be there and ensure they are well documented on your file. Yeah. Coming to disclosures, there are a host of disclosures to be done. I think we have mentioned depreciation method use, useful life. In case useful life or the depreciation rate used are different, then you mention that. Gross amount, accumulated depreciation, all these are very standard ones which are there. So please ensure you do not miss on any disclosures. Yeah. So at the end of the standard, the disclosures are there. Additional disclosures, the existence and the amount of restriction on title. So if you have any property, plant and equipment which is encumbered, that means which is offered as security, which you can't sell, disclose that. That's required to be disclosed. Even Schedule 3 requires that. Amount of expenditure recognized in the carrying amount of an item in equipment in the close of its construction. So if you have capitalized any expenses, okay, we used to have in the olden days expenses during construction period. Now generally when you have a project and there are a lot of expenditures which are incurred, many of them will be in the nature of revenue expenditure but having direct nexus. So just disclose what is the type of revenue expenditure you have capitalized. Yeah, that's it. So I think that's about whatever I can take in AS10. We are already running short. We'll just shift to the next one. AS16 on borrowing cost. Again, a very, very important standard from the auditor's point of view, because the client would like to capitalize many things as borrowing cost, because that shows profitability. But there's an overall limitation. Whatever gets capitalized on an asset, please always cross-verify with the replacement cost. So if an asset is getting if you're going to capitalize a lot of revenue expenditure, interest, and you find that the capitalization is much more than what you can buy an asset, that element which was getting over-capitalized needs to be charged out to P&L. It's common sense. If I can get an asset for 100 rupees, why will I permit my client to capitalize 120? I need to use that. So this is something which is missed. Small things, but which is something which is missed. So you need to be very alert. You need to apply AR, analytical review. You need to apply comparative test and ensure that there is no overcapitalization at any point in time. Scope. So this is a small standard we very quickly we will just cover. This standard does not deal with the actual or imputed cost of owner's equity, including preference share capital, capital not classified as in. So it's borrowing what an owner puts in as form as equity is an investment. It is not a borrowing. So it's very common sense that this is a correct exclusion in the scope, because what the owner puts in, there is no stipulation to repay back his capital. Capital is only there when the company closes down. Definition of borrowing costs, just two things which I want. Borrowing costs are interest and other costs. Generally, we have a misconception that only interest forms part of borrowing costs. There are other costs which we will just inspect. And it has to be capitalized for a qualifying asset. Now, qualifying asset is an asset that necessarily, now if you look at the dictionary, necessarily means something which you cannot avoid. Okay? So you have to find out, is it avoidable or non-avoidable? So qualifying asset is an asset that necessarily takes substantial period of time to get ready for its intended use or sale. Then and only then it becomes a qualifying assets. Otherwise it is not. So what are the components of a borrowing cost? Interest and commitment charges, yes, we all know that. Amortization, now this is something which is missed. Amortization of ancillary cost relating to borrowings. So this is also part of a borrowing cost. Amortization of discount and premium on borrowing cost. Exchange difference, but there's a cap to the extent they are regarded as interest cost adjustment. So if the exchange difference is not part of an interest cost adjustment, they don't qualify to be a borrowing cost. They cannot be capitalized. Finance lease, finance charges for assets acquired on lease finance are also borrowing cost. So exchange difference, we just very quickly, there's a good example given in the standard when it should be considered as borrowing cost. Should be an adjustment to the interest cost restricted to interest loss on the principal. So there's a calculation which is shown. We'll just run through the calculation. Treatment, yeah. So there's an example given, very simple example given in the standard itself. So there's a borrowing of USD 10,000 at 8%, and the closing rate, the exchange rate was 45, so it comes to 36,000. Increase in the liability towards principal amount. So at the end, at the reporting date, the exchange was 40, so there's a difference, 50,000 has been calculated. Interest if the loan was raised in India. Now that's what the standard says. You have to find out, had the same amount been borrowed in India, what would have been the interest cost? So that needs to be calculated. So if the borrowing was done in India, what would have been there? It would have been 12%. So calculate that, we came to 54. The difference between 54 and 36, 18,000. Let's take it. The treatment of exchange difference, rupees 50,000. 18 will go towards borrowing costs as per AS 16, charged to P&L, and 32,000 only will be capitalized. Now the client may put an argument is the other way around, capitalize 50,000. Be careful, do your homework, make sure you don't make this error. It's a very simple one. Coming down to capitalization criteria, let's check the capitalization criteria. Let's go further. Yeah. So borrowing costs are capitalized as part of the cost of qualifying asset when it is probable that they will result in future benefit and measured reliability. This is what we checked in AS 10. We'll also be checking that in AS 26. So this is the cardinal principle. Please put that in your mind very clearly. Future benefit and to be measured reliably. Borrowing costs not fulfilling the criteria are charged to statement of profit and loss in the period which they incurred. So keep on inspecting this. The client may give you whatever their point of view is, but these are the two very, very clear criterias. Document it. If you are thinking otherwise and you feel it should be yes in the favor of the client, ensure you are properly documenting it. Recognition of borrowing cost eligible for capitalization. First, specifically incurred. So if the term loan is specifically taken for an asset, it qualifies. Okay, so it's very simple. Just apply the interest rate and then capitalize. Generally incurred. So generally the company may say, okay, we have taken a OD facility, but some part of the OD facility was also used for assets which are under construction, assets which are in the CWIP stage. Again, apply skepticism and see what portion which the management feel needs to be capitalized. Apply weighted average rate of the interest, capitalize the borrowing cost, less income. So if the borrowing cost, so generally what happens, the company may get a loan, a term loan is taken, but immediately is not deployed. In the bank, they may keep it for FD. You have a sweep facility. Nowadays, that's permitted. Till you do not utilize, it's an FD. Whatever interest you earn, you have to credit the borrowing cost. So what has to be capitalized is only the net. So the interest income earned on that funding needs to be credited to the borrowing cost and only net amount to be allowed. No, it would not. It would not, provided there's a justification. But it should be on the auditor how he ensures that OD was applied. That you be very careful, because they may just cook up some sort of an explanatory. That's why I always say be careful, apply skepticism, be very alert, because management would like to do that. And when we put a qualification there in Caro, we should not be caught up that in one side you allowed capitalization, on the other side you are giving a different opinion. So you're right, it should be in sync with what has been done. So, yeah, correct. If the payment is made from the OD, it's very evident. But payment per se making does not qualify. It's the utilization. Ultimately, how it has been utilized. So it's substance over form. In form, it is one, but in substance, what happened? That's something which you need to check. Yeah? So the amount of cost capitalized during the period should not exceed the amount of borrowing cost incurred during the period. So this again becomes very, very, very important. Very, very, very simple thing. Somebody will say, how this can happen? But it has happened that what is got capitalized was much more than the cost incurred. So please prepare your analytical review report very correctly. Ask your senior to first check what is the amount paid towards interest, what is getting capitalized, it should not exceed. Many times we have seen when I go to do peer review or when I did my QRB review, many places we found this error. And even in my firm, when I did a second partner review, this is something which came out. A simple thing, but somebody erred on it, that you should capitalize only to the extent it is incurred, not more than that. Appears very common sense, but generally one errs on that. Excess of the carrying amount of qualified asset over its recoverable amount. That's what I put that. The actual cost of the asset plus borrowing costs should be less than or equal to the recoverable amount of the asset. Yeah. So if you are going to overcapitalize, it will exceed recoverable amount and then you are erring again. The excess should be charged out to statement of profit and loss account. Many clients have erred, many audit teams have also erred on this. Important point, when should capitalization commence? Appears very simple. Following conditions should be satisfied. Expenditure, the first criteria is expenditure. It should relate to the acquisition, construction or production of the qualifying asset. So if an expenditure is incurred, ensure there is a nexus, that it is incurred towards the acquisition, construction and production. Incurred. It should be incurred. Yeah, it should not be something which I budgeted. It should actually be incurred. Cost should be actually incurred. Activities. Necessary activities to prepare the assets for its intended use or sale are in progress. So this is important, which means you should have the site visit. So ensure the audit team, whenever it goes for stock take at the year end and there is some site which is under construction, do visit it so you get a good perspective of what is happening to the borrowing cost, whether the activities have started or the activities have not started. Other condition, expenditure incurred as borrowing cost is reduced by any amount of grant received or progress payment. Yeah, so grants, if you have received, just credit it. Activity necessary to prepare the asset includes technical and administrative work prior to commencement. So many times before you start an activity, there will be the design team, there will be the technical team who will be spending a lot of time till the physical activity starts. If it can be demonstrated, if you are very sure there is convincing evidence, okay, you can permit that capitalization, provided the client has a proper system of tracking this. So the tracker should be very good. If the client is using ERP, it becomes easy. If you have cost centers, if you have cost codes, every expenditure should need to pass through a cost code. It becomes easy, then the accounting entry is just easy to follow. Abnormal interest costs, unrelated costs should not be capitalized. I think this is very common, but it's not there in practical life. Many times unrelated interests are also capitalized. So you may have some clients who deliberately take a chance. They capitalize everything and they say, let the audit team come and let them remove out what they feel is not required to be capitalized. Many times we may just skip it. We may feel that client has done something right, but please inspect back, because interest cost capitalization is a very material aspect of our audit and needs to be seen very properly. Example, work on land development when in progress, borrowing costs can be capitalized, but development is suspended. So that's why I said you need to visit. So if you find that the development work has stopped, that the client is constructing a housing complex and suddenly the work on the housing complex has stopped, you should not permit capitalization of that interest cost, because these are abnormal things. They are not related to development. So capitalization should be ceased at that point in time. Suspension of borrowing cost, I think I've dealt with that. Temporary delay, yes. Temporary delay necessary for preparing of the qualifying asset. You can permit capitalization. For example, if the work is suspended during seasonal rain, if you are doing some work in interior Maharashtra or on the Western Ghats, rain is seasonal, it is going to come. It's something that cannot be avoided, but that has to be factored when you are doing your cost estimation. So please study the cost estimation when your client is prepared. Yes, we have factored. They will be delayed due to seasonal rain. This is the period, 3 months, and so I need to document that particular aspect. Example, capitalization to continue during extended period needed for inventory to mature. So inventory, for example, if your client is manufacturing wine, inventory needs to mature. So you need to give time. Now that is part of the activity. You may not find any activity taking place except that liquid in the barrel. They'll be in the barrel in the brewery and it is getting matured. That is permitted. So you need to see the bill of material where this is factored as part of the manufacturing cost of wine. Yeah, this much period will have to be kept in the barrel, so it's permitted. Construction period in a particular region. Okay, so if in a particular region, as I mentioned, due to rain, then not to be considered as abnormal. Such eventualities are factored in the cost estimation. Cessation of borrowing cost. Yes, borrowing cost should be suspended when the activities are not there. I just given one example of a construction of the business park comprising of number of independent buildings. Borrowing costs should cease for completed building. So if there's a complex where you're building 10 buildings, 5 are completed, 4 are the completed one, you have also handed over the possession, people are coming to stay, it's just ready to use, or it is ready to use but is not being sold, but no particular activity done, cease capitalization of borrowing cost. Borrowing cost disclosure, yes, very, very important. We have some balance sheets which will show later on how all these have been disclosed practically. Any entity, an entity must disclose the borrowing cost that has been capitalized as part of the cost of the qualifying asset, including details about the specific asset involved, borrowing rates used, and the capitalization and the period during which the capitalization occurred. Essentially, any significant information relating to how borrowing costs were treated when construction or acquiring an asset. So these are some things which to be given. Yeah. So I think with that we can, yeah. So just one more point, key point about exchange gain loss on borrowing under AS 16. Any exchange difference arising from the foreign currency loan is typically considered as part of the borrowing cost to be capitalized if directly attributable. So we had that example where we showed that it is adjusted towards the interest, right? So I think I have dealt with the important parts on this. Yes, I just have half an hour more and 2 standards to go. We'll take AS 26, intangible. Again, a very, very challenging standard. Unlike tangible, you can't see this. Most of the cost which gets capitalized are expenditure in the nature of overheads, which in the normal circumstances one would be incurring. But according to client, they are supposed to be capitalized because they meet a particular criteria. So we need to be very careful to ensure that the criteria are met before they are capitalized in the books. The objective is very clear. The objective of this statement is to bring the accounting treatment for intangible assets that are not dealt with specifically by another standard. So what we are going to deal is with principle, criteria for recognition, measurement of the carrying amount of an intangible asset, and disclosure obligation. Intangible assets are also required to be tested for impairment. Again, I'm always emphasizing that. So we always feel that only tangible assets need to be tested for impairment. It's not so. It's a misconception. So these assets also need to be tested. Okay. There are many definitions, but we will just not go into it. One part of that, an intangible asset is an identifiable non-monetary asset without physical substance held for use in the production or supply of goods or services, for rental to others, or for administrative purpose. So it's very, very clearly, we will just go back, what does the definition actually say? Yes. What is an intangible asset? Asset that do not have tangible substance. Okay, looks very simplistic, but what should be that? Most intangible assets will have a tangible manifestation or a container. Now, tangible manifestation is, for example, if you have patents, copyrights, what is the tangible manifestation? You'll have a certificate of registration. If you have a software, it may be in a hard disk. That's a container in which a software, otherwise you can't see it. So one has to first look at what is the type of expenditure or what is the type of investment the client says that we have invested in intangible. What sort of a manifestation does it have? Yeah. Some intangible assets like goodwill may not have any tangible form at all. Correct. Because goodwill will exist with the business. So if the business diminishes, goodwill diminishes. but yet the client wants to bring that on the balance sheet. So that's where the difficulty arises. And that's where we as auditors need to be very careful. And that's the place where the regulators or the reviewers who are reviewing your file will haul you up. Yeah, how did you permit an expenditure to be capitalized? Certain assets have physical substance but require intangible assets to operate. Yeah. For example, you have a mobile. The cost of the mobile is very soft, but the software inside that makes it a smartphone, that's the intangible. Okay. So one has to understand what is the intangible. It's the knowledge, it's that some edge which you get above another competitor's asset, which will help you. Best example are automatic machine mobiles. As I said, they are operated on software. So there are some lathe machines which I have seen in our client's place, which are only operated unmanned. They are operated only by the computer operator. So you'll have a raw material going in, a small program is there which will convert that raw material, a rod or a bar, into a particular shape without anybody doing. So it's not the machine doing, but the machine is being guided by what you call robotics or by the software, which becomes the intangible. And now you have AIs doing so many things. So whether they really qualify, one needs to see that. Yeah. General guidelines for recognition. In case the intangible part does not have an independent value or has a low value, the tangible portion is not considered as separate part. Sorry, I read intangible. In case the tangible part considered as a separate asset, it is capitalized as part of an intangible. So if you buy a software in the disk, it's not required that you'll rack your brains to find out what is the cost of the pen drive on which the software was there, which got loaded. So I'll remove the cost of the pen drive and put it in tangible or charge it out of PL. We can just capitalize that completely as an intangible without being too perfect on that. Intangible assets covered by other standards, yes. AS2, intangibles held by an enterprise in the ordinary course of business. So for example, as I mentioned, software is an intangible, but software will not be an intangible for Infosys, who's in the business of selling software. So that's why this is not covered here. It's an exception. Okay? So you have to find out what exactly. So if the company is in the business of selling software, you don't capitalize that, you capitalize it as inventory, and that becomes an exception here. There are some exceptions coming out also from AS22, accounting for deferred tax. Financial asset, monitoring asset, not covered under the definition of intangible because it is in the definition itself that it excludes monetary assets. Goodwill, we'll deal with it separately. What is that? Yeah. Unique features of intangible, as I mentioned earlier, first, it should be identifiable. So if the client claims that this expenditure has brought an asset into recognition and it needs to be hitting its balance sheet, you first need to find out if it is identifiable. Just paying consideration which cannot be identified is not an intangible. Okay, so just paying an amount does not qualify. Paying an amount is the administrative part of completing a transaction. Ultimately, the transaction gets completed after you pay the liability. But whether that cost needs to be sitting on your balance sheet as an intangible, there are criteria to be met. The asset should be separable is not the primary condition. Yeah, so the asset should be separate. No, not necessarily. What the asset is doing or what that expenditure is doing. So if an intangible asset is acquired with a group of assets, the transfer of legal rights will identify them. So generally, assets intangibles which are acquired will come by way of agreements where the seller will transfer rights to the acquirer. And the test is whether the acquirer can register those rights and claim his rights on the intangible in the court, because it doesn't have a physical substance. You just can't go and pull a trademark, or you can't go and pull a patent. So whether it can be registered. If it can't be registered, then you cannot enforce your rights. Be careful in case of such assets. Yeah. You should have control on that asset. That's another important thing. Financial non-monetary assets. Yes, financial assets are not covered under the definition. Entity meeting the criteria of an asset. Yes, entity should have control over the asset. Very important. If control is denied to you, then you cannot say that you are controlling that asset and you are getting economic benefit. So many times you may have an asset in a property which belongs to the government, and government may decide to put restrictions. You can do this or you can't do that, and everything is decided. Then whether it's really an intangible, one needs to. Control is generally exercised through legal rights, as I mentioned, to a court of law. Without physical substance, yes, we have dealt with. Examples of intangible. We are all aware. Computer software, scientific or technical knowledge, design, implementation, okay, import quotas, fishing licenses, landing rights. They are held for use in the production or supply of goods for rental. So for example, this is a very live situation. One of my clients had a landing rights. Okay, they are in the aircraft business, landing rights. Now we have learned that we need to capitalize all those expenditures which are going to be incurred to bring this asset for its intended use. So if you have a landing rights, I mean, I'm not asking the question, just apply your mind. What expenditure does that entity needs to incur to make it usable? Just because you got a landing rights, can you land your aircraft in the airport? These are some questions which you need to ask. What is the type of expenditure they need? Otherwise, that particular rights which you got, or you procured, or you bought, or you got it by way of a government grant, does not qualify it to be earning revenue for you. So you may have a landing right, but you can't earn anything because you have not set up the facility. So what is the type? So these are some things very, very practically we need to see. So the client may show you, yes, we got a landing rights, we got fishing license, but they have done nothing for it. They have done nothing for it. They don't even have the intention of selling it out. So whether they really qualify of hitting your balance sheet as an intangible. So this is something which you need to apply your mind. Asset held for disposal or consumption is not an intangible. I mentioned that. Infosys having software, they are holding those software for disposal as part of earning their normal revenue. Recognition and initial measurement, stringent recognition principles. Yes, as I mentioned, it is probable that the future economic benefit attributable to the asset will flow. This we checked in tangible assets also, and the cost can be measured reliably. Both the criterias need to be met in its entirety. It's not a case of either or. They have to be met cumulatively. So it's not one condition is met and the other, okay, it can be implied, or it's common sense that I have this. No. You need to, before you permit accounting of intangible, or permitting the accounting of an expenditure as an intangible, if both the criteria are met. Enterprises uses judgment to assess the degree of certainty attached to the flow of future economic benefit. I give you the example, having landing rights or having a fishing rights. What did the company do? Did it set up facility to ensure that I can commercially exploit the fishing rights which I have? Or it's just a right on the paper which I have? So these need to be inspected, they need to be documented. Many times company will be incurring large promotional expenses. Nowadays lots of companies are doing advertisement on KBC, Kaun Banega Crorepati, crores of rupees have been spent. And the company said, this is my intangible. Permit me to capitalize the cost of promotion. Okay, this one example which I've just taken from. Can cost of promoting new product be considered as an intangible? You need to apply a test. If this expenditure was not incurred, what would be the type of turnover that the company would have earned? And compare it with what the type of turnover the company earned now after incurring. Is it material? Is it consistent? Or is it just one time? Okay, initially everybody got carried away with KBC, carried away with Amitabh Bachchan, and everybody said, okay, chalo, we'll promote this product. If there is consistency, there is no consistency, can it be measured? Can you predict future cash flow? Or there is no probability coming up? Or so these are some things which one needs to inspect and see. So yes, if measured in terms of turnover, enterprise needs to ascertain what would have been the sale if the promotion expense was not incurred. It should result in lower turnover. If both the conditions are satisfied, an intangible asset may be recorded, else it should be spent. So 90%, if you ask me, it should be charged out to revenue, P&L. It should have very, sufficient, appropriate audit evidence supported by skepticism. It should stand the test of scrutiny before you permit such expenditures to be capitalized. Value of initial recognition, the intangible asset should be initially measured at cost. That's always the case. The cost should incur all that I said normally incurred to make the asset ready for the intended use. I gave you the example that about the landing rights. What additional costs does the company needs to incur to ensure it can explore those? Any expenditure that is directly attributable to making the asset ready for its intended use is also included in the cost, but that has to be demonstrated. Okay. We just take asset acquired in exchange, again using fair value. If acquired in exchange of shares and securities, this is something which is different. If an asset is acquired in exchange of shares and securities of the reporting enterprise, the asset is recorded as its fair value or the fair value of the securities issued, whichever is more clearly evident. So there will be a valuation report, generally it will be done by a third party. That would be. If acquired in exchange or part exchange of another asset, the cost of the asset acquired is determined as per principles laid down in AS 10. So what is the asset cost given up? What is acquired? We have all dealt with that. Criteria for capitalization of internally generated asset. So there's a technical phase. Now this is somewhere where again the client will prevail with you. They have an R&D department and they will say the R&D department, whatever cost has been incurred needs to be capitalized because we are coming out with X, Y, Z, whatever it. So please see that. If it is the general guidelines is, if it is still at the R&D stage, so what they call technically gate 1, gate 2, gate 3. So if the expenditure is at gate 1, okay, so the expenditure is traveling now from gate 1. Gate 1 is at a very prevalent nascent stage. The company doesn't have a budget to go to gate 2 or gate 3, ensure it is charged out. If it is coming to gate 2 or gate 3, what is the possibility that this expenditure will go to its maturity and there will be a market? The whole criteria means there should be a market for whatever you are claiming is my R&D. So if there is no market for what you are doing, it will be very difficult. So just to give you the best example, we are all talking about AI, artificial intelligence. I don't know how many of you know that artificial intelligence was in incubation stage 20 years ago. It is not today or yesterday we are reading so much about it. But this work had started 20 years ago. And at that point in time, many of those companies who are investing in that had to write off these expenditures because they were not sure. They couldn't demonstrate that there would be such a gaga about it, and the whole world, including the parliaments and all business establishments today, saying it very, very proudly, we are using AI. Because we are using AI, we are going to do X, Y, Z, and whatever it is. 20 years ago, it was not. It was at gate 1. It was at R&D stage. So many companies in US had to write off this, and many of them also went bankrupt. So today we are talking about it, yes, because there is a market. But if there was no market, it had to be written off. So be very careful. The client may tell you all this, we need to capitalize, we need to check. So there are many criterias which are there, but I'll just skip that. I'll just share this PPT. Amortization of intangibles. Now here again there is a rebuttal that it can be amortized not more than 10 years, but there could be a possibility that your asset has a useful life more than 10 years. Here it is preconceived that 10 years is the maximum, but you can have. So the client says, no, my asset has a life more than 10 years, then he has to demonstrate it by technical justification. There should be a technical report, and again applying the standard on auditing. Please ensure proper assumptions. You scrutinize the assumption used by the valuer saying that the asset has life more than 10 years. So you have to apply skepticism to that to ensure you don't default. Otherwise, getting a third-party report is very easy. You can just get, because as auditors we say there's a third-party report, and based on that I can. The third-party report for such expenditure is not the same as getting a third-party report for actuarial valuation. Many make that mistake. They said, sir, but for actuarial valuation, you took the report of the actuarial. Why you're questioning here? Both are different. They may happen to be from a third party. Everything from a third party doesn't mean it is gospel truth, or it is like a holy cow that I need to accept it without questioning. So you need to be very careful for what purpose a third party report is used. Generally they will say, sir, we'll get for you a third party report. Like when you do verification of contingent liability, they say we'll get you a lawyer's letter. And you'll find the client has so many lawyers letterheads with them. They'll ask you which one you want. And they'll type it also, and the lawyer may sign also. So you need to look at substance. You need to look at it very, very carefully before you do that. Yeah. Useful life, yeah, there's so many things to be expected. Many factors need to be considered for making estimation of useful life. Expected usage of the asset. Product life cycle. Expected action by the competitors. I don't know how many of you knew there was a company called Nokia which had bought cell phones. It went out of India. Samsung was way behind Nokia, captured the market. Nokia was better. Bad prediction. Couldn't understand. They relied on reports given by marketing agents. They said, you'll not be able to sell more than 1 million cell phones in India. Today when you're selling a phone, cost is not a consideration. I have so many articles in my office who are holding phones costing more than 1 lakh, 1.5 lakh. So when you say no, cost is a consideration, I don't think so. People are ready to buy a phone for 1.5 lakh, smartphone. So for what purpose? That's a different thing. But today people have that affordability. Nokia relied on a wrong marketing report. And they felt that, sorry, whatever we are investing in India, those intangibles will not give us economic benefit. They folded up. And I think today they must be repenting. So all these things keep on happening. They are all part of life. Some come. Product life cycle as a expected action by the competitors or potential competitors. Technical or technological obsolescence. Many such which will go. So what I'll do, I'll just touch impairment AS28 because there's just 5-10 minutes more for me to wind up before I do that. But AS28 is an important accounting standard, I thought, which is very important. Again, a very, very difficult standard to implement. A very difficult standard from the client's point of view and more so from the auditor's point of view. What's the popular misconception? Companies recording profit year after year, declaring dividend year after year. Then how can the assets not be productive? Same arguments are given when we do going concern testing. So why do you do going concern testing? We are recording profit, we are expanding. But when they are expanding, they are closing down also some other operations. Right? So it's very difficult. Now ask yourself, you have to answer to yourself very, very honestly. When you did review of fixed asset, did you really inspect why the company never did impairment testing? Did they give you any document? Very recently, NEFRA came out with a report and they said this particular audit firm did not challenge the assumption used by the client that impairment provision is not required. Nothing is documented. They reviewed the file. They said nothing was challenged. So very difficult standard more to explain, and it's more so difficult to implement. Applicable to all companies. So let's just very, very quickly run through what is that. So here the definition of value in use, which I used in AS10, was there. In the present value of estimated future cash flows. Thank you, sir, for permitting me to take this first slot. Very kind of you, very kind of you. Value in use is the present value of the estimated future cash flows expected to arise from continuing use of an asset and from its disposal at the end of its useful life. So when we are doing value in use, one thing which we generally forget, that we also have to consider cash flow from disposal of that asset. Our concentration is on cash flow of operating nature. What will I get? But we generally forget to factor what I would have got had I disposed that asset. So that becomes a very, very important part. Three components in that definition: present value of the estimated future cash flows, cash flow projection, and discount rate. All three can impact. Okay. Let's go further. Yes. Another aspect of the key definition, understanding these terms in the is fundamental to applying AS28 effectively. Recoverable amount serves as a ceiling for the carrying amount of an asset. So at what value the asset should be carried in the books? You should always test what is its recoverable amount. So the asset should not be carried more than that, otherwise it is overstating of the asset, which is not correct, which will have impact on the net worth. So the limiting factor is net selling price and value in use provide the basis for determining this limit, ensuring assets are not overstated on the balance sheet. Okay. Another popular misconception, come to that. Another popular misconception, impairment exercise, is it a fair valuation of the asset? When I do an impairment testing, do I do fair valuation of the asset? The answer is no. That's generally a misconception. Fair valuation is a very different exercise. Impairment is not fair value recording. Fair valuation fluctuates up and down based on the market. Impairment is only a reduction. Yes, it can reverse, but generally impairment is for reduction in the value of asset. That you feel the asset is overstated. It's stated much beyond its economic value. So it needs to be reversed. Impairment testing has to be done for all assets without any exception. Impairment testing should be done at the end of each accounting period. Okay. Now the question arises many times in practical situation. A company has bought a brand new asset. just few months before the year end. Say a company has purchased a new asset on 1st of February. Do I do an impairment testing of that asset? The client will say it's new. It's put to use. Do I do? I need to. I need to again test. Maybe I bought that asset for a particular reason, but market situations changed. And I know the cash flow will not be the same that I predicted when I purchased that, or when I intended to purchase that asset, when I made my projection. Okay, when I calculated my buyback period. Generally, I'll calculate a buyback period for the investment that I made. What is the IR rate of return? What will I get? So I did all that. At that point in time, I purchased the asset. And now the asset is gone. This happened in case of my client, one of my client. They purchased an asset which was used to grade rice. So the grains which are manufactured or which are grown in Punjab and all those things, they run through this asset. And because of the color coding, it can grade whether this should be a high grade rice or a high grade wheat or a high grade jawar or whatever it is. But the ground reality is changed. Preference of the market changed. Okay, people preferred one particular type of grain which that particular asset was saying is defective or is of a lower grade. Okay, so today people say you must eat husk, which is a very low grade rice. It's good for diabetes. You should not eat polished rice. That particular asset was grading it. It was not meeting his intended reason for the purchase. It needs to be tested for impairment. So the newness, the volume of expenditure incurred are not criterias. What the asset is going to do, what purpose it was supposed to serve, becomes the overall reason for that particular asset. Okay. Identifying impaired assets. Now this becomes very, very important from the audit point of view. At least whatever was given here, you make it into a checklist. Use this when you are discussing with the client and put his feedbacks. So there are reasons, external sources and internal sources, which can act as indicators. So now NFRA had this criteria ready-made with them when they were evaluating the file of that particular audit firm. And they said the minimum that you should have done was to answer these questions. Okay? So these are there in the standard, they are there in your book, you may expand it, but you need to answer whether there are any indicators for impairment. Okay? External sources, significant decline in market value other than due passage of time or normal use, significant change with an adverse effect due to technological marketing. I can just give you another example. One of our clients was manufacturing lithium batteries 20 years ago, and they closed down. They thought external market, oh, there's no market for lithium battery except Navy was buying. Today in all cell phones you require lithium battery. So there was a little poor marketing or poor test marketing done. They were not able to. Again, the problem was they appoint some agency to do test marketing, they appoint some agency to study, and the feedback given is not questioned. They just take it at face value. And that company today is repenting because they were manufacturing lithium battery, which should have been a hot selling. So all these things you need to at least inspect which are there. Measuring recoverable amount, estimate future cash flows, apply discount rate, determine value in use. Estimating future cash flows, yes, again, there are various short-term, long-term. I won't go, sir is already there, sir, I won't eat into your time. Yeah, long-term, short-term, all is there. Now these cash flows, you need not be very precise, right? But you need not be totally wrong also. You need to be realistic. So you need to be practical. How the cash flow. It's not that you're doing a projection or you're an expert, but at least one should understand what are the value drivers which are going to give you that cash flow. If the value drivers are weak, but the cash flow is strong, something is wrong. You need to question that. Okay, how can you say with a weak value driver you're going to get these cash flows? So that's what you need to do. The projection, short term, long term, generally they say when you do a long term projection, it should be 16 years, which is supposed to be one business cycle. So within that year, what is? Today it's very difficult to actually to understand. Yeah. And as I mentioned in the last, inflows from the disposable of asset should be included, which generally is forgotten. So one need to be taking that. Yeah. Applying discount rate, again, that can be a game changer. Somebody can play smart with the discount rate and change the cash flow. So just be careful what assumptions are doing. You should be pre-tax rate. Okay, cash flows also should be pre-tax, independent of the entity's capital structure. Discounting should be relevant to the underlying currency. It should be relevant to the market situation in which the entity is operating. So all these things are very, very relevant in seeing. Determining value in use, calculate the present value of the estimate cash flow from the use of an asset and from its disposal. Cash flow projection should be realistic, as explained above, which I mentioned. Recognition, again, how it is to be shown in the financial statement. Carrying amount, less recoverable amount, should be equal to impairment loss. So what is an impairment loss? Is your carrying amount exceeds the recoverable. Again, judgment required. Again, you need to exactly understand what the client is explaining, because they will be explaining otherwise. But you need to keep your thinking hat and use skepticism, use analyticals, use very common sense comparatives just to understand. Yeah. Impairment loss should be written off immediately once it is identified. Now, many times what happens, when the impairment loss is written off, the client may erroneously or otherwise, I don't want to compare, will be including this write-off in the absorption cost on inventory. It should not form part of your absorption cost. Okay? Impairment loss, impairment write-offs are not akin to depreciation. Depreciation will be forming part of your absorption cost. Impairment loss should not. So be very careful. Sometimes they will be adding, and we, due to hurry, we may not look into that, and we may just end up skipping. So be careful on that one particular aspect. Yeah. Impact on depreciation calculation. Depreciation be calculated after recognition of the impairment loss. Depreciation charge for the asset should be adjusted over the future period. Okay. Impairment will also have impact on DTA, DTL. Okay, so be careful, because they are not allowable expenditure. So you'll be writing back when you do your computation. Fine. Depreciation is an allowable expenditure, impairment is not. So please check the DTA aspect of that. Cash generating unit, yes, identification, consistency, I will not deal. Goodwill and impairment. Allocation of goodwill is very important. Which segment it is going to be, which operating segment it will be, we will just show you. But just be careful. Internally generated goodwill, the standard says, should not be recognized. Externally procured goodwill meets the cut for recognition, provided you apply the test and see that. But internally generated, many times we err on that by permitting the client to do that, and then when we are hauled up by the regulator, we do not have sufficient evidence to justify something which was specifically told not to be done in the standard. So just be careful on that particular matter. Reversal of impairment loss, yes, can happen. Again, need to check using skepticism. What are the criteria, what are the situation, whether they really stand the test of scrutiny, or whether it is just one stray case. One swallow doesn't make the summer, they say. There will be one particular year where there will be just a good year, and they said, okay, this asset can be the impairment done on this asset can be reversed. Just be careful. Ensure that you test it properly, that it will be consistent and warrants reversal. Again, reversal, how to impact it, whether to take it to P&L or whether to take it to revaluation surplus, again depends upon the criteria. If you have a revaluation surplus, take it there first. Thereafter, if the asset is not there, to take it to the P&L. Yeah. I'll be just taking the last part, which is so that, what are the practical difficulties in application of this standard? Indicators of impairment. Okay, we are lucky that our standard has those, but you need to be doing more and more reading of the industry in which your client operates. We are supposed to be doing, in any case, the essay says, knowing the business of your client, that in any case we are supposed to be doing, but we need to do it a little more extensively. Estimating realistic cash flows. I mentioned that. Cash generation unit, CGUs, identification criteria. How is your client identifying CGUs? Many clients do not. The best way of identifying would have been in your FAR register. So when your client is doing, so you can mention to them. Now most of them are in ERP. So you can mention to them that yes, in your ERP you should flag it. This particular asset which I have purchased belongs to which CGU. Okay, so from your system itself. Otherwise, the client will be marking on an Excel sheet. One Excel sheet will be changed. Next year, something else will be marked. Something else will be dropped, and you won't know. Let it be system driven. Very difficult, as I mentioned, not very easy. Even when you take it up to the audit committee, they will ask the client, they will ask the auditor themselves to suggest. So be very careful on that. Yeah. Okay, with that, then there are a lot of disclosure. I will just go to that part where the FRRB, there is some observations made by FRRB. I've just summarized few of them covering the standards. So I thought with that, and then finally I'll just close. FRRB. Yes. Just take it down. This is on which standard? On AS 16. This was an observation made by FRRB. Okay, on AS 16. What was the observation? Net cost of derivatives. Net cost of a derivative was considered as borrowing cost. Okay, and the comment was that it should not have been done. Derivative cost should not be added to the cost of borrowing. The accounting policy followed by this, some of the companies are not in compliance with the requirement of the standard. Okay. Another on AS 10, underutilized idle assets and assets held for disposal are recorded at estimated realizable value. Again, it's wrong. The accounting policy followed by some of the companies are not in compliance. What should have been done? It should have been lower of their net book value and net realizable value. Okay, it's not one way, it's lower of these two. And it should be mentioned in where? In your accounting policy. So significant accounting policy, generally we do not re-inspect. We feel it is like a holy cow. It is just passed on like the family silver from one audit team to another audit team. It needs to be re-inspected. Yeah. Next one. Intangible assets. ERP software has been included under the subhead capital work in progress, with the opening and additions during the year having been transferred and had nil value. That means initially it was parked in CWIP, and when it was put to use, it was not debited or it was not shown as intangible. It must have gone to a tangible asset. Again, they said the accounting policy, some software being an intangible should have been shown separately under the intangible assets. Otherwise, it will indicate that it has been clubbed under other components of the fixed asset. So very important from this observation. Yeah. Impairment of asset. Some of the company's statement of accounting policy did not contain any accounting policy. Blunder. It should be there and you need to follow it. So first, it should be on the accounting policy and you need to follow. Yeah. Okay, just take that little up. Can you take it up? Just push it up. I can't do it. Yeah. Down. What did NEFRA report on impairment? Okay. Auditors did not. So this is a recent NEFRA report. I have been mentioning that. Auditors did not have adequate documentation to ensure the absence of impairment indicators. The standard has given you indicators, but that auditor's file did not show how they evaluated those indicators and how they concluded that impairment testing was done and impairment loss provision was not required. Auditors did not have an understanding of how the management makes accounting estimates on impairment. Again, very, very, very important. Those of us who are doing listed companies, we are a little safer because we have an audit committee. Whatever management can't give you, take it at least to the audit committee. But those who are doing non-listed, small entities, you face a big problem. Your file needs to be more self-evident. Yeah? Auditors did not challenge the assumption used by the management. Right? So just to conclude, from what I have said, ultimately skepticism should be used. And what is skepticism? Many keep on asking. So I've just got a clipping of one Hindi movie where skepticism is shown. Please see it. So this movie is Kurbani, where there are two thieves, Feroz Khan and Vinod Khanna. There's a plot. Feroz Khan offers himself to be caught. Amjad Khan, the inspector, uses skepticism to find out that this was a fake robbery. Okay.
गाड़ी के नजदीक आने से पहले उसकी लाश गिरनी चाहिए। पुलिस? ये कमक क्या कैसे आ गई?
मारे गए।
अली शाहबाज कलंदर, अली दम दे दे अंदर। उठ बच्चा। बहुत अच्छा चाल था तुम्हारा राजेश, नहीं तो वो लोग तुमको जान से मार देता।
खान बाबा, ये सब आप ही की मदद से हुआ है।
वो गिदड़ का बच्चा हमारे आदमी को असली पुलिस समझकर ऐसा गायब हुआ कि सांस तक भी नहीं लिया। चलो चलो चलो, अमर इंतजार करता होगा।
इमरजेंसी कंट्रोल रूम।
हेलो पुलिस।
यस।
हाँ देखिए, मेरे सामने की बिल्डिंग में डाका पड़ रहा है।
कहाँ?
7th फ्लोर पे। बिल्डिंग का नाम है रिवियरा नारिमन पॉइंट।
आप अपना नाम बताइए, बहुत जरूरी है।
हाँ हाँ मैं समझ गया, लेकिन मुझे बीच में मत डालिए। मैंने खबर दी है, बस इतना ही काफी है।
हेलो हेलो हेलो।
पुलिस को फोन किया?
हाँ।
माला माल हो गए दोस्त। 1 करोड़ का चक्कर है इसमें। तू ये ले, नीचे करीम खान इंतजार कर रहा है, तुझे प्लेन तक पहुंचा देगा। सोच क्या रहा है?
तुझे छोड़कर नहीं जाऊंगा, तू साथ चल।
फिर वही बात।
राजेश, तू मेरी बात मान, तुझे जेल जाने की कोई जरूरत नहीं। इस दौलत से हम दुनिया के किसी भी हिस्से में इत्मीनान की जिंदगी गुजार सकते हैं।
कहीं इत्मीनान नहीं मिलेगा दोस्त। पुलिस को यकीन हो जाना चाहिए कि मेरा इस बड़ी चोरी से कोई ताल्लुक नहीं, इसलिए मेरे यहाँ पकड़ा जाना बहुत जरूरी है। अमर, 1.5 साल की तो बात है। देख पुलिस आ रही है। सुन, चोर से मिलने का कोड याद है ना?
हाँ, ईश्वर का दूसरा नाम दोस्ती है। मैं शीला से क्या कहूंगा?
समझा दे अमर।
तुम?
हाँ इंस्पेक्टर, मैं।
आईपीसी सेक्शन 379 रीड्स इनटू सेक्शन 511 अटेम्प्टेड रॉबरी। चोरी करते वक्त पकड़े जाने की सजा 1 साल, 1 ईयर।
और अगर मेरे पुराने रिकॉर्ड पे जज साहब की नजर पड़ी तो शायद 6 महीने और, यानी 1.5 साल।
राइट।
फिर सोच क्या रहे इंस्पेक्टर? लगाइए हथकड़ी।
चीचा गालिब का एक शेर याद आ रहा है, सुनिएगा।
इरशाद।
बेखुदी बेसबब नहीं गालिब, बेखुदी बेसबब नहीं गालिब। कुछ तो है जिसकी पर्दादारी है।
क्या मतलब?
मतलब साफ है, तुम और इतनी मामूली सी चोरी में इतनी आसानी से पकड़े जाओ, बात जरा घटिया सी लगती है।
इसमें घटियापन की क्या बात है इंस्पेक्टर? सब कुछ आपकी आंखों के सामने है।
जब ये वर्दी पहनाई जाती है ना, सबसे पहली बात ये सिखाई जाती है, जो कुछ अपनी आंखों से देखो उस पर यकीन मत करो, जो अपने कानों से सुनो उस पर यकीन मत करो, अपनी अक्ल इस्तेमाल करो, सच्चाई की तलाश करो और उसके बाद, सिर्फ उसके बाद यकीन करो।
आपकी नजरों में हकीकत क्या है?
वो भी हम इंशाअल्लाह तलाश कर लेंगे। खान, क्या या थैंक यू। देखा, उसका नाम लिया ना, हकीकत सामने आ गई।
कौन सी हकीकत इंस्पेक्टर?
राका के घर चोरी हुई, उसकी तिजोरी से 1 करोड़ के हीरे गायब है।
उससे मेरा क्या लेना देना है?
उसी से तुम्हारा लेना देना है। ये सब दिखावे का पोस्टर है, दिखावे का।
इंस्पेक्टर, तुम कभी साबित नहीं कर सकोगे कि उस चोरी में मेरा हाथ है।
तुम ठीक कहते हो, इतनी बड़ी चोरी के इल्जाम में तुम्हें गिरफ्तार नहीं कर सकता, अलबत्ता इस खून के इल्जाम में जरूर कर सकता हूं।
नहीं इंस्पेक्टर, मैंने खून नहीं किया।
शट अप!
मैं कहता हूं मैंने खून नहीं किया।
जस्ट शट अप एंड लिसन टू मी क्वाइटली बॉय। तुम्हारा सारा रॉबरी का प्लान मेरी समझ में आ रहा है। तुमने और तुम्हारे जिगरी दोस्त ने मिलकर एक डबल चोरी का प्लान बनाया था। तुम राका के घर में चोरी करोगे, उसकी तिजोरी से जेवरात निकालकर अपने दोस्त के हवाले करोगे, तो उसके बाद तुम्हारा दोस्त हिंदुस्तान से हमेशा के लिए फरार हो जाएगा। तुम यहां इस दफ्तर में एक मामूली सी चोरी करते हुए पकड़े जाओगे। जायज है तुम्हें 1.5 साल की सजा लगेगी और उसके बाद तुम और तुम्हारा दोस्त राका की दौलत से ऐश करो। तुमने पुलिस को धोखा देने की कोशिश की, तुम्हारे दोस्त ने तुमको धोखा दे दिया, ये खून कर दिया और यहां से भाग गया।
ये झूठ है।
ये सच है।
मेरा दोस्त ऐसा नहीं कर सकता। मेरा दोस्त ऐसा नहीं कर सकता।
तुम्हारे दोस्त ने ऐसा ही किया है। तुम्हारी दौलत तुम्हारी माशूका को लेकर यहां से फरार हो गया है। तुम्हारे हिस्से में आई है जेल की सलाखें और फांसी का फंदा। सिर्फ
Okay, so that's skepticism.